Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my analysis of Alphabet, which is the holding company of Google, YouTube, Android, and many other brands that you may well know. So let's get to it. So here is the structure I'm going to use. As you may already know, I structure my analysis in two parts. One is the qualitative part, the other one is the quantitative part. The qualitative part, I analyze 4 points: past performance of the company, management, competitive advantages, and financial position. And only if these 4 pass my criteria, I will start analyzing the quantity, which includes making 10-year projections of the business and then computing the intrinsic value and the IRR. So let's get to it. Let's first start with the past performance of the business, not past performance of the stock. So I'm going to highlight a few points of the earning call. Today, this is Sandra Pichai, the CEO of Alphabet. Today, I'll review some of the important work we've done this quarter across Google and Alphabet, with a particular focus on our growing cloud business, which we are breaking out as a separate segment for the first time. So cloud, now we are going to see the numbers. From the same earnings call, I am very pleased with the progress here, referring to Google Cloud. Google Cloud delivered revenue growth of 47% year over year, above the growth rate of the cloud overall. So Google Cloud is gaining market share here. More than 500,000 channels live streamed on YouTube for the first time in 2020. Videos on our new Shorts, this short is to compete with TikTok, are receiving 3.5 billion daily views. This number is amazing. 3.5 billion daily views. So half of the population of the world on a daily basis, roughly. From the same earning call, this is Philip Schindler, Senior Vice President or Chief Business Officer of Google. We are pleased with Google services revenues of 52 billion in the fourth quarter, which continued to significant rebound from negative impact of COVID. So in the second quarter, the advertising business came to slow growth, and later in the year it picked up. So consumers continued to move more of their activity online, and advertisers responded. So you'll see in the figures how this is picking up. This is Philip again, and this is a comment I'd like to highlight. We've long said that we want to make Google the best place for users to start their shopping journey, regardless of where that journey ends. And this is, of course, the juiciest of search, which is someone looking for something or some service with the objective to buy something. Google here has great competition from Amazon, and there's a nice article of March 2021 of the New York Times, and it talks about the difficulties that Google is having to compete with Amazon. And it says here, Amazon is a fixture in the lives of many Americans. It has usurped Google as the starting point for shoppers and has become equally essential for marketers. Amazon is incrementally used as the first web page that the shopper goes to search for something, even though I think Google has great product to compete with. This is Philip again. We've always believed that the future of Google and the future of our partners are fundamentally linked. We only succeed when our customers and partners succeed. One number I think it is worthwhile highlighting in this context. Over the past 3 years, we paid out nearly 140 billion to our partners. This means people that, for example, uploads content to YouTube, or developers of apps. So the business model that Philip is referring to here is a sharing of advertising revenue with content producers or creators, and I think this is working very well because it's making like a win-win proposition. So let's now see how Alphabet opens revenue. We can see here, this is the 3 segments that they disclose: Google Services, Google Cloud, and other bets. Google Services includes advertising, which is Google Search, which we all know, YouTube Ads, and Google Network. And Google Services, it also includes Google Other. And Google Other, we have app-in sales, we have YouTube TV, Premium TV, which is a subscription. And we also have digital content. And the acquisition of Fitbit is going to come here. And then we have the cloud, as I just mentioned. And as you can see, Google advertising grew 22% on the fourth quarter of 2020 compared to the fourth quarter of 2019, which is a nice pickup. Especially here, YouTube ads, 46% of growth is amazing. The Google Cloud also 47% growth. Google Other also grew quite nicely at 27%, mainly I think mostly YouTube subscriptions. And overall total revenues grew at 23% in the last quarter. This is the number of employees, which grew to 135,000, 14% from last year. So now let's move to similar breakdown, but on a yearly basis. The last 3 years, you can see here, this is the total revenue growth, 13%, 2019 to 2020. It has decelerated a little bit from the previous year. As you can see here, this Google search came dramatically below what was used to grow before here. And so you can see Google Ads got hit from the previous year, but the cloud still growing quite nicely on a yearly basis as well. YouTube ads was a bright spot on this advertising business. Here in operating income, you can see Google Services is the only segment producing positive results, and also look at the nice margins that they have. Let's see revenue in a graphic way. Here, revenue grew 19.1% on a compounding annual growth rate in the last 10 years. And this is the growth rate, which has been over 10% and even 25% at times. And revenues and operating income, again, but I am going back all the way 10 years. You can see here YouTube and the cloud. We only have from 2017, and here is the compounding annual growth rate for this period, 2017 to 2020. So because otherwise I cannot compare, because I don't know what part of YouTube is inside here. You see that the growth is quite nice all over, roughly, except network, which is not growing as fast as the rest. And here you have the last 3 years of growth from YouTube ads and from Google Cloud, which are the new sort of reported segments. And look, these are great growth every year. And Google Other is also growing quite fast, except in 2017. But the annual growth is 25%, which is quite nice as well. Overall, search grew at 14%, which is not bad. And let's now see operating income. We see here the total operating income that grew at 15%. This is on a 10-year basis, the compounding annual growth of 10 years, 15% on operating income. And the operating margin, look, it's quite nice. Only a year of 20%, but all of them are 25, 30%. So this is a graphical representation of what we just saw. Okay, and this is, let's go to the free cash flow on a graphical manner. It grew 18%. This is operating cash flow. And it grew 16% free cash flow, the green line. Here you can see this yellow is my way of analyzing capital expenditures versus revenue. And it's been 12%, sometimes 16%, but normally on the 12% level on average. This is similar to what Facebook is spending in terms of capital expenditures versus revenue. Okay, and this is the capital expenditures, this gray line here. So let me show you some relevant excerpts from annual reports or the IPO letter, which will make us understand Google a little bit better. Google is not a conventional company. We do not intend to become one. This is an IPO letter. We take a long-term view and manage the portfolio of other bets with the discipline and rigor needed to deliver long-term results. Every year there are trillions of searches on Google, and we continue to invest deeply on artificial intelligence and other technologies to ensure the most helpful search experience possible. Many companies get comfortable doing what they have always done, making only incremental changes. This incrementalism leads to irrelevance over time, especially in technology where changes tend to be revolutionary, not evolutionary. We continue to look toward the future and continue to invest for the long term. As we said in the original founder's letter, we will not shy away from high-risk, high-reward projects that we believe in because they are the key to our long-term success. This is Larry Page. Our alphabet structure is about helping each of our businesses prosper through strong leaders and independence. You may already know that Larry and Sergey are great admirers of Warren Buffett, and I think that they are molding Alphabet in a similar way to Berkshire Hathaway. So they have a holding company with lots of independent companies that can share not only technology but financial strength, talent, and all this vision of long-term thinking, innovation. So it's in a way they keep each unit independent in terms of the decisions. They have a CEO on each of these units, and it gives these other bets, for example, and the smaller companies within Alphabet a better probabilities of success. A management team distracted by a series of short-term targets is as pointless as a dieter stepping on a scale every half hour. This is the definition of long-term view from Larry Page, and I totally agree. We will not shy away from high-risk, high-reward projects because of short-term earning pressure. This is another trait I love in management. They don't manage their company based on whatever Wall Street analysts, which are short-term oriented by nature, are demanding. Don't be evil. We believe strongly that in the long term we will be better served as shareholders and in all other ways by a company that does good things for the world, even if we forgo some short-term gains. This is an important aspect of our culture and is broadly shared within the company. I like this way of thinking. We have a dual class structure that is biased towards stability and independence, and that requires investors to bet on the team, especially Sergey and me. Some people may not be that comfortable with this dual class structure. I'll talk about it a little bit in a minute. But I think it's important in the case of Google and Alphabet because of this stability and independence. You need this type of dual class structure to be able to apply this way of thinking. High risk, high reward, not short term. Don't be evil. Don't put profit in front of everything. All that, I think, in the long term is going to pay off, and we will be better served not only as he said, as shareholders, but also as in all other ways, as users even, as customers. So I think I am happy with that. But let's not jump into management discussions. Okay, so let's go now to the structure again. I just discussed past performance and of the business of the past 10 years, and this one ticks the mark. It's been great performance, not only in terms of revenue growth, but in terms of free cash flow, in terms of operating margins. So everything here for me, it's a tick. Let's go now to management. Management is what are the traits of management, and things that I like are, for example, frugality, not excessive perks to managers or to executives, a long-term view, long-term orientation, good capital allocation. I also like when management has a good percentage of share of the company, so they have meat in the game. Another important thing is to have a clear mission. And for example, here this is the mission of Google: organize the world's information and make it universally accessible and useful. This is a very clear, and if you think about all the businesses within Alphabet, at least the ones we know, they all fit very nicely in this mission. So this is not just words. This is a great mission to guide and to keep focus. So some relevant excerpts again that I showed you before. I want to show you here the number of times they mention long-term view, the number of times they mention short-term pressure, meaning they don't want to fall into short-termisms like Wall Street. So here you can see already a couple of traits I like. Let's see a summary of compensation, and some couple of things I really like. For example, the founders, none of them receive anything. Not only they don't receive salaries or stock, but they don't receive any compensation here. If you see here, when I valued Facebook, I showed all other compensation for Zuckerberg and Sandberg and the CFO. Look at this big chunk of money going for security and the aircraft. And also even in Amazon, they are getting all other compensation. Bezos is getting decent security, but still getting something. But here, Larry and Sergey are getting nothing, which I think more than the money that they are getting here is more a matter of principles. This talks a lot about the type of people that these two guys are. Also, salaries are not overly excessive, and stock awards are every 3 years. The amount here is 46 million, except for Pichai, which is getting substantially more. But this 46 million every 3 years is much less than what Facebook executives, which are getting 20 million each year. So this compensation compares well with the compensation of Facebook and Amazon that I did before. Another point from the proxy statement: no additional executive benefit plans. So they don't differentiate between the benefits of executives and the benefits of other employees. And this is great. I like this. Our named executive officers do not receive cash bonuses. You may know that cash bonuses, I think, are useless at this level. They are not useless for other employees. But at this level, people that is receiving 20 million in stock every year, and then you start working on cash bonuses, whether it's 1 million, 100, or 900,000. It's a waste of time. So here they are not doing it, which I love. And they do not hire consultants, which is great, I think. And they have a simple award system, which is based on total shareholder return over a period of years. That's it. There is no formulas over a period of years, so that it's not a short-term thing. What I mentioned about the voting rights. Of course, if you see, all executive officers get 52% of the voting power. So they have majority. So whatever we as shareholders want, probably we don't have a say. Mainly the two founders have a majority voting, and together with Eric Smith, they have even roughly close to almost 60%. You have to trust these two guys, and in my case, I prefer to have Larry and Sergey rather than be, let's say, subject to some investor, some activist investor coming and trying to manage and trying to influence Google with mainly financial or short-term objectives in mind. So I'm not too worried about this. And then in terms of capital allocation, they bought YouTube, they bought Android, and these were two great acquisitions that at the time that they did the acquisitions were people was not too convinced, but you can now say that Alphabet without YouTube and without Android would be a much different company and probably a weaker one. They also have these moonshots, which is money that they are investing in high risk, high reward projects. That, like for example, this Project Loon. After 7 years, this Project Loon was phased out last January. So what I see here is that they are investing, as you see, 3, 4, 5 billion in negative operating earnings on these projects. But the moment that they see that it's not working, they just cancel them or phase them out. But they learn a lot from each of these, and I think one day probably one will be a big winner. So this is just a great way to have like a call option embedded within the company. They also have Google X, which this is the new logo. So Google X has been restructured lately, in a couple of years ago, to ensure that more projects are successfully taken through to market or killed far earlier in the process. So they are working to have oversight by a group called Foundry, which is tasked with reducing project risk and bringing them to fruition quicker.
I'm Astro Teller. I'm the captain of moonshots for Google X. Google X is a part of Google that's been set up to try to pick some particularly audacious, positive things to do for the world, and then get started on the experimentation necessary to create, at least occasionally, those successes. These projects will come and go. We'll be right about some, we'll be wrong about many. That's okay. What I'm the most excited about is how we approach these problems. So watching some of them do the brainstorming. What kind of people are they? How do they interact with each other? That culture is a massive multiplier on what you can really accomplish.
Okay, so this is all what they're doing in terms of capital allocation. They are not paying a dividend, which I also like. They buy back stock as a way to return money to shareholders. I only like management doing that when the price is lower than the value that they get. In the case of Google, all buybacks have been done at good prices, because essentially the stock the past 10 years has been trading below intrinsic value, in my view. So capital allocation is a pass. So okay, let's go back to structure. We just saw management. Management, as you can see, has most of the traits I like in management. So for me, it's a pass. Let's go to competitive advantages. Competitive advantages, I can identify 4, and they are in order of importance. Network effect, the most important and valuable one. Intangible assets, also very important and valuable. Then we have switching costs and barriers to entry, which are good competitive advantages to have, but they are not as valuable, I think, or as durable. Let's go to network effect. Let's see, for example, Google search. The more users searching, then the better the results, because Google, with artificial intelligence and with all the data that they are handling, can, let's say, understand better what people is searching, and therefore produce better results. Even in 1994 or so, when Google was competing with Yahoo or other search engines, there were articles saying that Google was the one producing the most relevant search results. And since then, they have only improved, and they are improving faster than the rest. So these better results are going to get better with time. This, of course, brings more people to search into Google. So this is a network effect, a virtuous loop. But also, this produces data, as I mentioned. And here is what I see. The more data you have, also the more users are going to be searching, because of course the broader the search is going to be, and the better the results. So this is all connected. But it's also connected, this data, with other businesses within Alphabet or within Google, like Gmail, Chrome, Photos, Google Maps. All these are feeding into this data pool, let's say. And these are free services, but we as users give in kind all this data that feeds all this loop. But data also improves these services. Like, for example, the more data you have, the better is Google Maps. Because, for example, when you go into a traffic jam, the more people is using Google Maps, the better information you can get from other drivers, let's say. So, and this you can think about of all of this. So this is a great network effect that all is around Google search in this case. This attracts advertisers. So advertisers that want to list on search, and advertisers that want to use this massive amount of data to make their advertising more relevant. I don't think advertising is intrusive in the case of Google searching, because whenever you're looking for something, you get a very well labeled advertising, so you know that those are advertisings, and sometimes they are useful because they are very relevant to what you're looking for. And if you don't like them, you just scroll a little bit down and you will get the organic results. And again here, the more advertisers you have, the better the results, because I think that, as I said, sometimes it's good to have what you're looking for, even if they pop us as an advertising. So this is the whole connection of loops. Also, let's say, for example, YouTube attracts content creators, and content creators attract YouTube views. So this is also a loop. The more content creators, like me, for example, the better the service for a YouTube viewer, and the more YouTube viewers, the more content creators that are attracted. So this creates a loop that is growing really, really fast now, lately. But also, here's the problem, let's say, it attracts advertisers. And in this case, advertisers, I'm not sure that attract more YouTube views. So this is not a great connection. This is similar to what Facebook is facing, this problem. In the case of YouTube, I think it's a little bit better, because when you're watching something, you get very, very specific advertising related to what you're watching, so related to your interest. It's not the same that when you're checking your feed in Facebook and you get all these types of advertising that not necessarily have anything to do with your interests or even your interests at that moment. So in this case, I think that there isn't a connection, but it's neutral, let's say. It's not negative either. In any case, you can use, now they have subscription, so if you don't like advertising, YouTube can still make money by subscription, and I think that's great. And I don't know if Facebook is going to follow something like that, instead of advertising, monetizing their businesses through subscription. They haven't mentioned that, but YouTube is doing it, and I think it's going to be big, and you've seen it's growing quite fast. So let's go back to intangible assets. all proprietary technology and the brand. I think the brand is important here. It's even a word. You can use it now as instead of saying let's search for something, you say why don't you Google it. This is recognized as a great value, when you go and look for something, when you search for something. So the intangibles assets here are really big. In intangible assets, you have all the data also that Google has. Of course, all the artificial intelligence that they are developing to analyze this data and all the algorithms and all that. There's a great quote here in this book from Scott Galloway. The name of the book is The Four. And he says, with our queries, we confess things to Google that we wouldn't share with our priest, rabbi, mother, best friend, or doctor. It summarizes the power of the data that Google has about every one of us. This is a great intangible asset. In terms of switching costs, I think it's a good competitive advantage that they have as well. Not as durable, but if you're a YouTube, for example, creator, and you have built your YouTube channel for many years, you're not going to switch to a competitor just because it offers a tiny bit better, whatever, I don't know, tool. I mean, in order for you to do to jump to a competitor, you have to get great benefits to sort of like to compensate for the costs that you are going to experience. Not only costs in time and probably in money, but also intangible costs and how to build, for example, your own brand in YouTube and stuff like that. And this happens also in photos, in Gmail, in the Chrome. I mean, you have Chrome, for example, if you use Google and you have Chrome connected in all your devices, you don't want to switch to a new one because you have to set up everything again, and the benefits are not that much better, but the costs are real. So this is a switching cost is important, but not as important as these two. And barriers to entry, as usual, this type of businesses need copious amount of money to run. Like you saw, 22 billion in capital expenditures per year, and that's growing and growing and growing. It's 12% of revenue in essence. And so to keep up with the type of investment that these guys are experiences every year, not many companies can do that, financially speaking. Not to mention the amount of money necessary to build all the infrastructure that they have. So competitive advantages, a big tick for me. Really, I think this could be one of the businesses I have studied that together with Amazon, I think the two of them have the highest competitive advantages that I know. I don't know Apple. Probably Apple could be in the same league, but I mean, these are top 5, top 5 of the world in competitive advantages. This is a business you have to own. I mean, this is a business, a value creating machine. But let's not get ahead of ourselves. Financial position. Financial position, I'm going to be quick. I'm going to show you this is marketable securities, 110 billion, which is the excess cash that they are not using to run the business. And this I use in my calculation of net debt. Here, this is the cash that they use to run the business. So, of course, I'm not using it as part of the net debt calculation. Long-term debt of 13 billion, nothing. And operating lease liabilities of 11 billion. So all in all makes an 85 billion net cash debt. So net debt, negative net debt. So here is a 10-year, you can see net debt has always been negative. That means they've never had debt really. They have had more cash than debt in the past 10 years. So there is no risk, zero chance that Google or Alphabet will go bankrupt because not meeting any covenant from a lender. So in essence, they own their own life. They don't have to sit down with any banker. In fact, bankers want to sit down with them, but they are not paying attention, fortunately. Okay, this is the debt. Okay, so financial position, tick. So tick, 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 tick. We can now move to projections. Let me show you. This is my model. Here I am showing the past 10 years. I'm not showing all because I can't. I want to focus here on the projections. I'm projecting 10 years, and this is the revenue. So I am projecting revenue to grow at the 14.7% compounded annual growth rate, which is below the 19% that they experienced in the past 10 years. The way I calculate revenue is by opening these segments the same way that they open it in the reports, and trying to project each of these. What I do is I start with revenue growth, and these blue cells are the ones where I am making my assumptions. In Google advertising, I am assuming 11% growth rate, or constant, which is lower than the 16%. In Google Other, which is 26 what they have experienced, I am going slowly down to 24, 18, 15. Google Cloud, I am assuming 32% growth, and then 29. And this 29 is in line with the growth of AWS. And in other bets, I'm keeping a similar rate than before. So all in all, I get this growth, which is what you saw, and these revenues. So this is the same I showed you a minute ago. I want to check that my revenues are given these growth rates are consistent with the markets that they are competing within. If you see here, I have each of these segments, and I can see what would be Google Ads and what would be Google Cloud in terms of the sales for the next 10 years. And I want to make sure that they fit within their markets. Here I'm showing advertising the way I projected it when I valued Facebook. And here you can see digital and mobile in billions, the projection I made with Facebook. And here, this is the projection I'm making for Google. And this is the market share for Google. You can see 37 to 45%, which is similar to levels as before, 38, 45. So I think this is reasonable. This 11% growth that I projected before, which is giving me these revenues, is within the market, let's say, within the growth of the market where they're going to compete. Another thing I like about these projections is that if I take Google and Facebook growth, this is the part of the growth in the digital and mobile business that is going to be taken by Google and Facebook. So I add the growth of Google and Facebook, and I see the growth of digital and mobile, and I see what percentage of that growth is taken by these two. And this is the percentage that Google and Facebook are taking every year from the growth of the advertising market, the digital. And this number is conservative, let's say, if you compare it with some analysts are talking, at least this was around this time of 18 or 2019, they were saying that Google and Facebook were taking 85% of the growth of the market for themselves. So this doesn't look that bad, you know. So between Facebook and Google, my projections, it fits within the growth of the market. And here you can see 27 plus 45 plus 7 is 77% of the market share of the whole business of digital and mobile advertising is going to be taken by Amazon, Facebook, and Google. And this fits within my projections of Amazon as well. And this is from, if you add this, is 65%. So 65 to 77 is, I think, completely reasonable. So revenues fit within the whole context of the advertising business in the way I am projecting it, and also it fits within the other companies I am valuing in the same space. So I am happy. Now let's go to cloud, and let's do the same for cloud. This is the way cloud infrastructure as a service is growing in my projections, the ones I made when I analyzed Amazon and the AWS. And this is what I am projecting for Google Cloud. And if you see, Google Cloud is going to get a 10% market share from this market, which is the same they have been getting in 2020. I think it's reasonable because they have great competition from Microsoft, from AWS, and even though they are growing fast, and as you heard the senior vice president saying that they are, and even the CEO, they are going to focus on the growth of the cloud, I am going to keep them not gaining any market share, even though they said that they gained market share in 2020. Okay, so I'm happy with cloud, I'm happy with advertising. Let's see now operating margin. So let's see, operating margin, the way I am projecting it is here in Google Services. I am keeping the 32% roughly that they had in the past. Then in the cloud, you see they have been losing money, and what I'm going to do is I'm going to assume that they make 20% in year 2030. What I'm doing is interpolating from 43 negative to 20 million to 20%, and this is going to be the operating margin. And then for other bets, what I do, because other bets is an unrelated business to sales, it's not related to anything else. So it depends on the number of opportunities they have. And what I'm doing here is, because they have been growing at the 5.3%, this operating loss, I'm going to make this operating loss to grow at the 10%. So this is what I'm doing here. This is the operating loss I am projecting for other bets. So this gives me an overall operating margin of 24 to 27. It's in line with the past, but as you see, it's improving slowly because, of course, the cloud is going to start growing, not only growing, but also growing and improving the margins. So I think this is totally reasonable. So let's go back to the initial slide where we have the revenue. I showed you the revenue already. I showed you the operating income, how I come with these two figures. Operating income, as you can see, will be, as I said, going slowly from 24 to 27 and growing at a 16%, which is in line with the past. And the EBITDA, the way I compute EBITDA is I take operating income and I take depreciation and amortization, which I project as 56% of capital expenditures, which is the same level that they have had in the past. And then that way I get EBITDA. As you see, the EBITDA margin is in line with the margins of the past. So this is a good check I'd like to make normally. And also this is another check, which is the EBITDA to operating income is at the same level that it has been in the past. So I'm not making any assumptions that make the business completely different. I am assuming diluted weighted average shares outstanding. It's going to be the same, no growth here. So that means that any dilution by stock compensation is going to be compensated by purchases of buybacks. Then let's go now to the balance sheet. What I'm doing here is I'm keeping the same level of net debt, so I'm not assuming that they will keep growing their cash balance with free cash flow. what I'm assuming is that free cash flow is going to be put to use in the business. So then I am assuming 20 times enterprise value to EBITDA, which is going to be the factor I'm going to use to calculate enterprise value here, and market cap. So this is enterprise value, and market cap is going to be using the net debt figure. So market cap is bigger, as you see here, than enterprise value. With that, I get the price based on the EBITDA, which is market price divided by the number of shares outstanding. So this is a targeted price, let's say, and in year 10 of my projections, 6,374 would be the target price based on EBITDA. But then I do the free cash flow as a second valuation avenue. What I do is I project the operating cash flow at the 14%, and I am using capital expenditures to revenue of 12%, which is in line with the past, even higher than some of the past years. And so I get free cash flow growing at this level. And another check I make here is that free cash flow to EBITDA, I want it to be similar to what it has been in the past. And then I take 23 as the enterprise value to free cash flow. So with that 23, I compute the enterprise value here, which is 23 times free cash flow. And then to enterprise value, I add the cash, and I get the market cap, and with the market cap, I get this price, free cash flow price, divided by the using these stocks outstanding. This is my target price of free cash flow, and this is year 10, 5,400. So what I do is I make an average of these two, the 6,734 I showed you before and the 5,460 now. This is going to be my target for Google or Alphabet in 10 years. And then what I do is I calculate the IRR. If I buy at today's price, this is the target, and I'm using, it says here dividend per share, but in the case of Alphabet, it's purely free cash flow per share, and this comes from here. This free cash flow, what I'm doing is I'm taking free cash flow, but I am deducting any stock compensation. That will give me, if I deduct, say, 15 to 48, will give me 46 per share of free cash flow, which I'm going to use here. And this I'm going to use it as a yield. So I get the IRR using the prices plus the yield, gives me the total IRR of almost 13% if I buy this at 2.25. And if then I do an exercise, if I buy it at 2.79, it will give me 10%, which is what I still would be interested to invest in Alphabet with a 10% return. So this would be my fair value for Alphabet. Let me just show you one thing here. I grabbed this Credit Suisse valuation, discounted cash flow analysis up to 2026. If you see EBITDA in 2026, 188 billion. If you see my EBITDA in 2026, 125 billion. They are being quite aggressive, I think. Unlevered cash flow, let's say unlevered free cash flow, 131. My free cash flow for 2026 is going to be 98. So again, 30% higher. So, but then when they make the whole valuation, they get to a 2,300 fair value. And as I showed you, I get 2790, 27. So Why is that? They are assuming higher growth, higher free cash flow, but then when they make the calculation, we get to a smaller, and even they are using a 10.5 weighting average cost of capital, which is the same I'm assuming here, 10%. And this is because this is what I want to share with you. They make only 5 years of projections at whatever the growth that they assume. You see here the capital expenditures, they are assuming that it grows very small, 2.4, even below the growth of the business, 21%. That's not possible, I think. You have to keep pouring money in this business to make it grow. You cannot just put 2.4% growth in capital expenditures. But in any case, they make a 5-year projection of whatever growth, and then they make a growth of 3% from here thereafter. This is not true. The business will not grow at 21% for 5 years and then grow at 3% forever, like a cliff. So that's why the way I'm doing it, projecting 10 years, is more accurate, I think, to value the business. Because what they have to do here is they have to overgrow the business in order to make the price similar to what it's trading today. I think. Sorry, this Credit Suisse. Credit Suisse is a great brand. The guys here must know lots. I am just a single humble YouTuber to be. But this is something I wanted to share with you. The way these big banks are making their assumptions, I don't think it's quite accurate. I don't know. Another thing I want to share with you is, if you see the price here that I am targeting, this is the target price. Even though I'm not paying attention to anything, only to the last one in the year 10. But if you see, this would be the target, let's say, for 12-month target price. And it's much lower than the current price. The current price is here. So what happens here is that if I buy Google at 2.25 or Alphabet, I am buying 3 years of growth in advance. This is the benefit of owning a business that creates value. You buy it, probably you buy ahead of time 2 or 3 years of growth, but if you keep the business for 10 years, you're going to be rewarded with a 13% return. This is to show you the value of investing long term, and to investing in a good business. This is something that Munger it always says. It's better to invest in a great business at a fair price than in a fair business at a great price. So if I pay fair value to get involved and partner with Larry, with Sergey, and with this marvelous engine of producing value, then I am happy to invest at fair price, buy 3 years of growth in advance, but then I will wait for 10 years. This is why Google or Alphabet is together with Amazon and together with Berkshire, the three of them, I think are over 10% of my portfolio, each of them. So the three of them are 30 something percent of, or even 40% of my portfolio. So because I really think that these are businesses, I don't care what they're going to do in the next year or the following year. I'm caring what they're going to do in 10 years. And I think they're going to be great businesses in 10 years. So go Alphabet. That's my valuation of Alphabet. I hope you liked it. If you liked it, give it a like to the video, and I'll see you next time. Thanks very much for watching. Bye bye.